Can anyone hear me? Yes. Now, yes, probably you can. But if I do this, you can't. Oh no, you can. Okay. Sorry again. I mean, just it just crashed at the beginning of this. It is what it is. Let me check if everything works. Yes, it does. It does here. I don't know if it does here, but anyway, so it seems to be working right now. So we'll start. You know what? I will start. I will start recording it. So if there's any issue, you cannot hear me, I think you should. Then I'm recording it, so I'll be able to repost it anyway, either on LinkedIn or YouTube. So if anything goes wrong, just go away, just do your thing, and this will be back with a video. So let's start. Lots of stuff to talk about today. So I mentioned that I will be shrinking massively the geopolitical side and the economy side, because it's kind of always the same anyway. I will only update you on major stuff or the funny stuff like we had yesterday at the White House. But anyways, so I want to spend more time on the markets, and this is why I started preparing what I call the market dashboard, where I will share with you quite a few indicators about the market, about the behavior of the market, and we'll be able to discuss that. What I'd like you to do is to give me some feedback about this market dashboard, so that it can be improved week after week and respond to your expectations, if you have any about this about this show. Anyway, so let's start. There's no reason to wait, right? I will check once again if this works. This seems to be working, so let's go. So Croissant files today. What do we have today? So we will start with the funny stuff. Yesterday, so you've all heard about the meeting yesterday between Zelensky and Vance and Trump. I mean, this was a difficult one, but I believe this is part of the negotiation. Zelensky behaved like a kid entitled to the protection of the United States, and he doesn't understand that many things have changed from Biden to Trump. Trump wants to get out. Russia is not the US primary focus anymore, and Trump wants his money back. This is what we've talked about the previous weeks, about the deal for rare materials, that kind of thing. So he needs to understand, and I believe this is what Zelensky and the Europeans are totally delusional about, that he needs to understand that he's by himself now, and that he needs to get the best out of the deal that will be concluded between Russia and the United States. Because like Trump said yesterday, you have no cards. If NATO, which means actually the United States, I believe that the UK, France, or even the new Germany with the new Chancellor, we'll talk a little bit about that after that, but they have no say in what will happen. It's been between the US and Russia, and both US and Russia have agreed to kind of eat the dying animal that is Ukraine at this point. So obviously Zelensky doesn't understand that. He's been quite unrespectful. Yes, he treated, so he insulted Vance in the middle of the meeting. It was on camera in Ukrainian. Obviously, probably Vance didn't understand at this point, but it was obviously noticed by many people. So again, he doesn't hold any card. He plays the entitled kid, and it's over. And I think that's part of, that's kind of Trump negotiation tactic. He makes the other party understand that they have no say in what happens, and after that, he kicked him out of the White House. Just probably to give him the time to realize what that just happened, and he has everything to lose. So that's the kind of negotiation style that Trump uses a lot. He kicks you away, and then you can start negotiation and discussions back on a new basis. I believe that's what happened. We'll see what comes next, but again, this is Ukraine that has more to lose in this. Trump, I believe, will want to come back to the negotiation table only because he wants to get the money back. And the way for him to get the money back is to go back to the rare material deal that he has, that he has discussed, that we've discussed over the past weeks. So negotiations will start again. It's just a kind of a stunt at this point. But that was very funny. That's not the kind of discussion that we usually see in front of the cameras. We know that Trump is a guy of communication, and this probably happened deliberately, on purpose, from the Vance-Trump team, for this to happen and push Zelensky to take his expectations down on the negotiations. So that being said, that was the fun part of this. So like I said, the meeting was cancelled. Again, kick him back, and then after that, the last line of Trump's statement, he can come back when he's ready for peace, meaning ready for accepting the conditions that I set with Russia. This is what it means. I think that, we've seen a lot of reactions in Europe supporting Zelensky, but, it's the fight, like we've said again former weeks, between US-centric Trump and the globalist in the rest of the world, that was Biden, and that are still in power in Europe. And so this is why, kind of Europe comes to the rescue at this point. But they have no leverage. They don't know. They have no army. They cannot really support Ukraine either financially or militarily. So that, kind of nobody cares, and both U.S. and Russia know it. So that's illustration was part of the deal. Some land to Russia, so the Donbass region of Ukraine, the resource to the United States. Europe will be left with the debts and the risk of sending some military there if they want to, and Ukrainians, I think they will get some glory just because they will want to appear like a negotiated exit, not losing the war. So let's move on. So we can talk a little bit about the German election. There was the AfD, the right-wing party, that was pretty high in the polls before the election. But this is not the AfD that won the election. That's more of a regular globalist party that won there. What's interesting, I believe, is if you look at the map of the election, the AfD was winning in the former Eastern Germany, where the CDU, that's the SPD. That's being kicked out. Nobody cares about the acronyms, but it's a regular Western style government that won in Western Germany, when this is the right wing party that won in Eastern Germany. There's a divide clearly between former Eastern and Western Germany, which means that they have never really glued kind of. The other divide that I've seen also recently about Western Germany and Eastern Germany is about religion. Western Germany is Christian, where the majority of Eastern Germany was less religious. Let's put it that way, which is consistent with the communist bloc that was there for between 1917 kind of and 1989. So the candidate that won the election last weekend in Germany is Merz. His name is Merz. Probably his name doesn't tell you much. The only thing that you have to know is a much warmonger chancellor in Germany than Scholz was before. For instance, Scholz refused to send long-range missiles in Ukraine because it was a risk that it would escalate into a much more global conflict. At the opposite, Merz is fully prepared to send these missiles in Ukraine because his strategy was to hit Russia inside to push them to the negotiation table. Everybody knows that it would not have worked, but these are the kind of the crazy guys that we have. And so today in Europe, we have, for very different reasons, we have the German Chancellor that is pro-war in Ukraine. You have Macron, who has pushed for war since the beginning against Russia, and you have Keith Starmer, who is again also pushing for war in Ukraine against Russia. So these crazy guys might do something stupid, but again, they can talk. This is part of their electoral basis, I would say. That are expecting that they are expected to support Ukraine by their electors. But I believe this is a risk. But there's nothing much they can do anyway without the U.S. support. None of them have a real army. So the only ones who have an army are the UK, for instance, France, who has the nuclear power in continental Europe. But not much more than that. The only second big army, I believe, in Europe is Poland. But they will not, even all of them combined don't have the necessary resources, again, financial. All of Western European countries are broke at this time, under a full load of debt, and they don't have the military to sustain a long-term conflict against Russia, for the same reason that Ukraine didn't have the means to win. I believe that the population in Russia is 140-something million people. Ukraine was at the beginning of the conflict about 40 million people. So the numbers don't add up. There's what is happening to Ukraine at this time, they are getting short of soldiers. So I've seen reports that they are sending disabled warriors to the front lines, some guys that are amputated. It's really sad that at this time, it's time to stop the suffering of the Ukrainian people. I say this before everyone says that I'm a pro-Putin apologist, but this is what it is. Okay, so next, what did I want to say next? Again, so I've said it multiple times. This is the Europe that has most to lose in this situation, and the deal that Trump wanted to sign with Russia and Ukraine is actually cutting Europe from Russia, because the US will deal with Ukraine. There will be a stronger commercial relationship between the US and Russia. and the ones that will lose part of that business will be the European countries. So I think that's a way to separate, to put a wedge between Russia and China. I don't know if it will work, just because Russia has poor history of trusting the European, trusting the West. Specifically, if you think about the Minsk Accord, that were not respected by the Western side. But anyways, I think that's what Trump is trying to do. It's what the focus now will be on China anyway. What I believe Trump wants is that Russia would not intervene in kind of a conflict, whether commercial or direct conflict, with China, if it happens, the same way that China would not intervene in Ukraine either. So I mean, it's the kind of, I believe, the deal that is going on at this time. This is just my interpretation of what happened, but we'll see. We had the second round of negotiations on the 27th, so that was three days ago, between some envoys between Russia and the US. It seems that both parties was pretty happy about the results of the negotiation, but obviously, sorry, what happens yesterday between Zelensky and Trump-Vance will probably, elongate, I would say, the negotiations. And here is why the focus. Trump again is a businessman. So, and here is why China is the main focus for Russia. You see the map between that shows the trade dominance between China and the US, which shows when the US is the largest trade partner for some country versus China. So the US in the 2000s were dominating totally the trade, and in terms of imports, but export as well. And now if you look at what happened in 2024, the China is dominating all Asia, all Africa, Southern America. So what I believe what Trump tries to do is to rebalance that kind of situation and conquer some economies back with all the means that he can have at his disposal. Whether it's tariffs, military. So that will be interesting to see during the next 4 years. But I believe this is what comes behind all actions of Trump. So let's move on to the economy. So we'll do this in 5 to 10 minutes, and we'll go to the markets. Like I said, I already significantly shrunk the geopolitical part. So let's go. Let's not waste any time. It's all over the same, because the situation doesn't change. The public debt in the US is always going to the roof. In terms of percentage of GDP, it's quite significant. What the little chart in the insert shows you is that overall in the Western countries, it's still increasing progressively and regularly. And this doesn't change, So the Congress has voted this week an extension of the budget, which is kind of a disappointment, if you ask me. We have DOGE that is doing a good job cutting waste, fraud, but again, like I said last week, I believe it's not more. It's also about cutting the funding to his political opponents, and again, this is where Ukraine comes also in the picture, but he extended the debt ceiling for the United States once again, which means that the debt will continue to rise and the deficit will continue to rise. So this could potentially have an impact on the inflation. Like, we've seen here the inflation is going back up significantly last week. So we had new numbers, so I won't get overwhelm you with numbers that we got this week, but inflation is going back up, and at the same time growth surprise are going down. So we have inflation with less or no growth at this time. So again, this is the nightmare that the Fed is in at this time. I believe, and my friend Andrei Louis Yakubovitz posted something this morning on LinkedIn, and he thinks that or if I understand well, is he supposed that the choice that the Fed will make will be to cut rates, which will push again the markets up. But whatever the Fed decides, they will have to make a choice. They will have to do either growth or tame in inflation. And I believe that inflation, I've said that many times, this will the one that will be sacrificed because it has a positive effect on the debt, a negative effect on the wallet of U.S. American, but positive effect on the debt because you don't. What you reimburse is in value is lower than what you got to sustain the growth. I believe that will be the choice. This seems to be what André Louis was meaning as well. So we'll see about that. Maybe a quick word. The housing sector is very important in the U.S. So you've seen that. So you see here that the delisting at the end of last year was quite significant. That's part of the cyclical market of U.S. housing. Just delist. In winter, where the market is down, to relist in spring. This is part of the game that real estate agents are doing as well, because you don't want to see a house that has been listed for 2 years, 4 years, 3 years. You just reset the clock at this point. So there is less selling in the market, but at the same time, the prices are not going down significantly. I had the example. One of my neighbors was trying to sell a house, and at a price that was, the one that she thought she deserved for a house, but she could not sell it. So she did exactly this. She delisted it and just relisted it a couple of weeks ago. So the housing market is kind of showing signs of weaknesses. Now we had the Dallas Fed manufacturing indexes updates so this week as well, and they all show the same pictures. The production is down, the new orders is down, and the employment is down, which means that the economy is slowing. Is the same thing that I've said, a couple of seconds ago, and the price paid are going up. So we are in a situation of stagflation, and again, the most likelihood for the Fed will probably be to support growth and activity rather than controlling inflation. So we'll see what the Fed does, but I would not be surprised if the Fed start talking again about cutting rates unless they totally want to undermine the Trump presidency, which is still a possibility. I don't have it here, but the expectations for interest rate cuts are going up at this time. So we move on to the markets. I've never been so fast for economy and the markets, but that's fine. I mean, that's pretty cool. I could have said a lot of things, but let's move on a little bit. So as an introduction, so we had one down day, significant down day on Thursday on gold. Yesterday the day started pretty bad for gold, but it recovered with the market. This is just a chart about the demand for gold that is increasing again in China and specifically in India. So they are acting like something is about to happen. The gold is kind of everything hedge. When you have no idea what's happened or you are expecting a really significant event, gold is usually the main shelter. In terms of equities, I saw this chart that I thought was quite interesting. I'm not a fundamentally based investor. I'm a purely quantitative, systematic based investor. But this one I think was kind of interesting because in terms of value, that is often described as a price to book ratio. We are back at the tech bubble level. So which means that it would not be surprising to say that the market is overbooked at this point. So it will be interesting to see, specifically in the context of the week that we just had, and the next week will be interesting to see where the markets want to go. Because next week will be again the European reaction to the meeting with Zelensky, which more directly impact Europe than it impact the US. So we had, the Max 7 is not so magnificent anymore. It had, since the beginning of the year, it's down about 4% when, the other sectors of the market, excluding the Max 7, are positive. So again, kind of anecdotal evidence that the market is changing. Another anecdotal evidence that the market is changing is that the US treasuries are back positive year to date. It's interesting because specifically the context of this week, we had equity markets going down and bond markets going up. So we have some negative correlation between the bond markets and the equity markets coming back, which, positive correlation is exactly what killed the 60-40 portfolio and the risk parity portfolios when in 2022 you had both bonds going down and equity markets going down. This week was interesting in the sense that markets were going down and bonds were going up. Does it means that the market participants are now considering US treasuries a safe harbor? Again, maybe not considering the debt, but it probably is mostly linked to interest rate expectation, considering what I just said before on the part of economy. So the markets are changing at this time, and I think this is interesting. So now we go back to the dashboard that I introduced last week. And so we'll try to spend a little more time. It's what, 11:48. So if we want to go up to the hour, we probably have 20 minutes, which means that I will try to explain you some of the concepts that are present in the dashboard. So let's go. Maybe I can check if I have comments or questions. The usual suspects are here. Hello, a good day. That was sad, funny. Yes, it's about the Zelensky thing. It's I know it is what it is. No real question at this point. So again, don't hesitate to put some comments and ask questions. I will take your questions and comments into consideration for the next week. If you are interested in what the dashboard is bringing, if it's interesting for you, if it's not, what you would like to see, and then make this evolve to something that is more interesting for you, because this is the kind of stuff that I do, that I look at, but I also want to do something interesting for you, and at the same time maybe I can find something interesting, what that's interesting for you, but also for me in your suggestions. So don't hesitate to put comment and ask questions, and we'll go from there. I will go full screen here, just for you to be able to see the numbers. So what do we have here in terms of dashboard? So we have multiple columns with the last price, the variation on 1 week. So last week you see on equity, SPY Qs down 1%, 3.4% on the Qs. Emerging market went down as well. So you still have the variation on 1 year, 5 year, one column that tells you how far away we are from the all-time highs. So for instance, here for the S&P or the SPY, you will see that we are only 2.62% away from the all-time high, which is not dramatic, I guess. So this is why it's colored in green. When you below 5% of the all-time high, like the Nasdaq is at this time, it's down 5.57% from the all-time high. I put this in white. I mean, it's not bad, it's not good. let's put it that way. For instance, if you look at TLT, for instance, which is the long-term bonds ETF, you can see, even if it recovered, it's still 40%, 38%, 39% away from the all-time highs. So yesterday last week was 44%, I believe. So that's a huge drawdown for the bonds. And again, that's what killed the risk parity and the 60-40 portfolio, at least for the last 2 years, so 2.5 years. So we'll see if it comes back now with the new decoration between these two asset classes. I also put in this dashboard for the numbers, the sigma, the volatility ratio. What is it? The volatility ratio is the ratio of short-term volatility versus long-term volatility. It tells you if it's above, if we are basically in tension. If this ratio is below 1, then this means that you're not really in tension market. But when this ratio is going above 1 and significantly above 1, this means that the market is in tension. But maybe even more importantly is the ratio. This ratio change week over week, because it tells you where this ratio is going. And with the increased volatility we had this week on on the equity markets, we see that this ratio has been increasing and is going closer back to the parity. So meaning the volatility long-term versus short-term versus long-term volatility is going closer to 1. So the idea is to say that if this one is going up, continues to go up, this indicates tension in the market and, you know, maybe more aware about the risk in the market that is happening. I have a similar indicator on volume. When volume are increasing, it shows again that the activity is increasing on this specific instrument. So I think both are interesting in telling you where the action is happening on specific instruments. Here, for instance, if you look at the S&P, you have the volatility ratio going closer to 1, maybe becoming above 1 pretty soon if volatility keeps rising. So this ratio is increasing. At the same time, the volume, is increasing as well. And you can see that maybe except the Qs, the volume is increasing on all of the equities ETFs that I have here. And the sigma ratio is also increasing on all the equity instruments that I have here, which means that it's getting more active on the equity, so it is time basically to pay attention. We have EEM, which is the emerging market ETF that is above 1. The FEZ, which is Eurostox equities, that is the ratio is above 1 and rising. But I mean, it's not necessarily a concern, specifically if you look at the Eurostox. The Eurostox recovered was doing pretty well recently, so that's part of the, volatility can be on both sides. It's more indicators of activity. So when you want to have an idea of where the action is going, that these two are, interesting indicators, if you want. So we have the same thing, on all so I did this on same thing on all asset classes. That being said, if you want to have more instruments, some specific instruments that you think that you would be interesting to look at in these in the dashboard, that would be again interesting. So I have the same thing on bonds, aggregated bonds, mid-term bonds, long-term bonds, tips as well. So we have the drawdown on the long-term bonds that we've mentioned before. Over 5 years, long-term bonds have been down 31%. It's over 5 years, right? Obviously, it's happened more in the recent times after 2022. But it's when you have down 30% of 5 years, your portfolio gets hurt. TLT, again, volatility ratio is above 1 and increasing. So the market is getting more active on equities, is getting more active on bonds as well. So the volume ratio is increasing as well. So you see that the market is getting more active. Something is reshaping at this time. Commodities, we have kind of a similar picture. This was a kind of risk-off week where you have, whether it's the general commodity index, DBC, or gold or oil, all were down on the week. Volatility increasing and volume globally increasing as well. Maybe except oil, because oil is back, like I've showed you many times, within its range, meaning that it's less interesting in terms of big moves for market participants. specifically, if you want to capture large moves or large trends. This is kind of a similar thing on Forex. I will talk very rapidly on Bitcoin, that is now down. That was down around the 81s yesterday when I made the snapshot. It's only 21% down from the all-time high that were, so on a weekly basis again. So don't tell me that the all-time was not this. I snapshot this on a weekly basis. So we're only down 21%, which, considering the volatility of Bitcoin, is not massive. I will make a little bit note on that later. You can see that the volatility is increasing despite the sigma ratio. The volatility ratio between short-term and long-term is below 1 quite significantly at 78%. But why? Because with the institutionalization of Bitcoin, we are in a long term, and with more market participants in this specific in the cryptos, the volatility is naturally going down. So it's totally natural that the short-term volatility is being lower than the long-term volatility. Now, it's more interesting, like I said before, is that we see that this ratio is changing on the upside. It is increasing. So it's increasing on the upside. It's also the volume also increasing significantly. So again, market getting more active across the board, whatever asset class you are looking at. Now I want to show you a couple of things that I think are interesting. So here you have ETFs since 2024, the beginning of 2024, that are representative of some major asset classes. So you have IBIT, which is crypto. You have gold, so metals. You have the S&P. You have UUP, which is the dollar index. You have USO, which is energy, and you have TLT, which is long-term bonds. So where are we now? So this shows you basically what the momentum has been on every single of these instruments. You see that IBIT, for instance, is still up 92% despite being down 20%, like I just said before. The S&P has been up 26% over the last year and 2 months now. Gold 40%, overperforming the SPY. So it's brutal raw number of momentum, if you want to see it. Why do I show you this? Because I wanted to show you kind of a concept which is risk-adjusted momentum, which is what most trend. It's the basic indicator of the way most commodity trading advisors, CTAs, are seeing, trend followers are seeing the market, which is a momentum indicator divided by the volatility. So it's a risk-adjusted momentum indicator, which is kind of more interesting because it gives you an idea. I mean, every CTA has his own, I would not say secret sauce because I don't believe in this secret sauce, but as is only every CTA has his personal way, specific way to address and to calculate momentum and to calculate the risk. And again, if we take the turtles aside who have a different investment process, most of them, the quants are doing some kind of indicators of momentum divided by the risk. And this is what we see here. So why is risk-adjusted momentum for the dollar much bigger than the the gold, for instance, when you see that the US dollar basically increased by about 12% when gold increased by 39%. Why? Because the FX volatility is much lower, and so this mostly represents the kind of exposure. It gives you an idea of the exposure you would have in a CTA portfolio. So where you need to adjust the risk on every component. So you would have more, for instance, dollar exposure in your portfolio than you would have gold, because you have to adjust the risk of your component. Here you see the SPY dropped in terms of risk-adjusted momentum this week. This was obviously based on two factors. The momentum dropped because the index dropped, and like we've seen in the numbers, the first table on the dashboard, that the volatility also increased. And so when you have a decrease at the numerator, if you want, decrease in momentum and an increase on volatility, you have both side effects where this decreases significantly your risk adjusted momentum. On the opposite side, you have we've seen that on TLT, the long-term bonds, we had momentum increasing and even volatility increasing as well. But at this time, the momentum, the pure raw momentum factor, was much bigger than the volatility increase. And so we have this recentering to zero at this point. So I think that what's interesting is not really to see the levels where it is, although it might be interesting. I believe that what's interesting in this is to see where the potentially some market actors like trend followers that are doing that style of investment are going. What does it mean? It means that because, for instance, on the equity markets, because the momentum is slowing down and the volatility is going up, so you have a significant decrease in risk-adjusted momentum for US equity markets, there might be some selling pressure from the CTAs on the equity market. So you will see, if you look at the two that moved significantly this week, you have risk-adjusted momentum for the equities going down. You have risk-adjusted momentum for long-term bonds going up. So you may be in a situation where you will have some reallocation from equities to bonds at this point. Again, the main driver will be what the Fed is doing. So if tomorrow you have someone of the Fed saying anything about the markets, the picture may change radically from one day to the next. But again, this is to give you some clues about that. Again, let me know in the comment if that kind of thing has any interest for you. I think it's interesting because it helps you figure out where the markets are going, which is where we want to know. I mean, it's always interesting to know where it is, but it's more interesting to know where it might potentially go. Remember, it's not an investment advice. I need that little thing, disclaimer. I'm just explaining the markets here anyway, and give you more clues than you may find anywhere else. So next we can go on spreads. So my basis for this on equities is to look at the markets versus the S&P. So you have the S&P that went down. No, you have the Nasdaq that went down against the S&P this week. It's not totally surprising, considering that the beta of the Nasdaq is above 1, so it's much more volatile, and so the moves in the Nasdaq are bigger than the ones that have happened in the S&P, so that's not surprising. The interesting point is that the small caps underperformed again significantly the S&P. It's not really surprising in the sense that when you have market stress, markets going down, it's natural for investors to go to the kind of safer stocks, which means more large cap indices, so from small cap to larger cap, which is the S&P 500. So that explains a little bit as well the rebound that we have in the Dow Jones Industrial Average versus the S&P. What can we do next? So we have similar chart on for European indices. So you've seen that from the beginning of January, we have a strong comeback of European indices versus the S&P. So FEZ is the Euro stock. You have EWQ and EWG, which are Germany and French index at the same level. They are coming back as well, probably on the expectation on the resolution of the conflict. The markets were closed at this time when the Zelensky-Trump spat happened. It will be interesting to see what the market reaction will be on Monday on the European equity markets. If it was just a stunt by Trump and Zelensky that will go back to the negotiating table very soon, or if this has an impact on the European markets. But whatever, the term that you see, if you see that on the last maybe 20 years, there is the US market and the rest at this point. What else can we look at? We can look at everything in the context of gold, which is always interesting, specifically considering the fact that the US is flooding the market with cash. So gold is the reference. So if you look at the S&P versus gold, basically it's been flat since 2021, up 10%. Again, this goes back to gold going up significantly, but for the same reason again, which is flooding the market with cash and inflation. So you have the Euro stocks not resisting so well, and the US dollar not resisting so well for exactly the same reason as the S&P. And that graph also shows that most of the growth after the COVID crisis on the S&P came from debt on the markets. It didn't come from actual growth, which is the most concerning. So if you want to have equity stock markets in the US going up, the Fed basically has no choice. And we know what the stock markets represent. It's all the 401k. Everyone has this. That's what investment advisors do. They put So until recently, they were mostly putting 60-40 risk parity and other portfolio, but most RIA portfolios, investment advisor portfolio, are following the market. So the US cannot afford having a stock market going down. This will bankrupt every single American in the country. And this is why they have to pump it always. So again, that needs to be taken into consideration, in my opinion. So this was the recent action. So we've seen we had correction this week with a rebound yesterday, but still volatility, implied volatility going up. The rebound yesterday probably doesn't mean much at this time. I always talk about smart markets and dumb markets. I consider smart markets, bonds market, and volatility markets when equity markets are more dumb markets. If you like, many we won't like this, but that's just my appreciation of this. So I think it's more interesting than yesterday, the bounce back on Friday, which probably includes some window dressing at the end of the month for fun, that some of them desperately needed a better print that was expected than what was expected on Thursday. But the volatility market doesn't show any sign of relief at this point, as you can see. So I don't think that yesterday's rebound meant much. We'll see what happens next week, but probably this one didn't mean much. This is again an explanation of what I what I told you about, about the volatility ratio at the beginning of the dashboard. You can see that both short-term and long-term are converging together, which means that we are at a point where basically we don't know where we're going at this point. It can be still going up if the market volatility recedes and calms down, or it could be going significantly, equity markets could be going significantly down if the market, if the volatility is still increasing. So you see this, there are a lot of clues about the market doesn't know where it's going, and it's kind of a risky environment. We've seen this on the activity indicators, the exchange ratio on volatility, on volume, making the case that the market is getting more active. Now we see this on implied volatility, where despite the rebound, implied volatility was slightly up yesterday. So at least it did not recede like the market. And then we see this on not only on implied but historical volatility, but this one is more or less another way to see the same thing that we've seen in the dashboard. Another way to see this is to look at the VIX term structure. So the market is expecting the same volatility today as is expected in 1 month. Usually the uncertainty is bigger in the future. This is why you have this contango structure for volatility for VIX futures. Now there is some stress at the short term for the first expiration of the futures, so it starts getting slightly in backwardation, at least for the two first expiry of the VIX futures. Obviously that is not really dramatic at this point, but it's interesting to be noticed that for the next months at least, the market is expecting anything. Basically they don't know. It could be as much going up or down, but they have no view. This is what I want to say. They have no view at this point about the next month. Because, for instance, I wanted to show you this, which was the VIX back term structures that happened in August 2024, last year, you know, when the market went down in a couple of days 10%. So, you know, August 5th, you see that the term structure was in a clear backwardation, so which indicates a lot of stress in the market. What was interesting is that, but that's not the point for today, but the term structure revert to something more let's say normal pretty rapidly in a very short period of time, when usually it takes much longer. And this is also explains why many volatility strategies have been caught in that kind of event, because it was very unlikely. Again, if you remember, it was induced by the Bank of Japan saying, okay, we don't play with this anymore, we won't increase interest rates, and this calmed down the market. You know, the talk of the day at the time was about the carry trade unwinding. So I just showed you this just to look to show you how a backwardation term structure looks like in terms of intense stress in the market. Obviously, when you look at this, we are not there yet. This just means that the market has no expectation, has no idea about the next month, because after that, the term structure is looking perfectly normal, no stress for the long-term future, only for the short term at this point. What else can we say? Yes, I mean, I took the opportunity of this to show you this. This is the spread between gold and silver. And why do I show you this? Because I don't want to talk about silver. You know, there are gold bugs, silver bugs. So the silver bugs always say that silver is way better than gold for whatever reason. The only thing is that they are basically kind of the same. Silver is gold with more volatility. And this is what the spread tells you. The spread has been between gold and silver has been evolving between 0 and, you know, minus 10, 20% for the last 20 something years. The beginning of the chart is in 2004. No, 2018, sorry. But basically this shows you that it's flat. It's doing the same thing. There's no better option in trading silver and versus gold, and this is why and actually when you are trend follower and the volatility is bigger in one instrument than the other, it's always easier to trade the smaller volatility instruments. So the way to trade silver and gold, in my opinion, this would be probably, you know, an approach that would be implemented in a hedge fund. Here, I mean, without testing much, do statistical testing about co-integration, you see that you have some form of co-integration between silver and gold. You have silver, you know, hovering around gold, which means that you can potentially play mean reversion. And that's, I believe, that's how a hedge fund would play this, silver versus gold. But if you take them separately, again, they are the same. The spread is, you know, hovering around 0. There's no added value, in my opinion, unless someone can say something in the comments and convince me otherwise. There's no added value to trade silver. It's even less interesting in the sense that being more volatile, it may gives you less quality signals about where the price is going. Basically, there is much more noise in this. So this is my explanation of why I will not talk much about silver anymore. I wanted to say this because I see a lot of, I often see you know, posts on LinkedIn about silver and that kind of nonsense. But I will stop there. So maybe, yeah, so my last point was about Bitcoin. We've seen Bitcoin is down 20%. Everyone was getting crazy. If you look at the median drawdown for Bitcoin, it's around minus 50%. I don't have the exact numbers. I think it's minus 49 something. But anyways, it's minus 50%, which means that when you are investing in Bitcoin, you spend as much time in a loss of more than 50%, then you spend in a loss smaller than 50%. So at this point, we are down 20 something percent on Bitcoin. That's not a big deal. Even if Bitcoin would go back to, a drawdown of minus 50%, which would take it around 50k something, that would not be a big deal. And I wanted to address, another post that I've seen on LinkedIn this week, which was about, drawdown of 20%. Again, not material for Bitcoin considering its volatility, but the same post is coming over again about the tulip effect, the tulip bubble. I mean, the tulips never recover, right? The difference with Bitcoin, you have, if it was comparable to tulip bubbles, it would have many tulip events in a row. So you would have one in 2011, you would have one in 2015, you have one at the end of 2019, another one at the beginning of 2020, another one around at the turning point of 2023. So you would have multi-tulip events, and so far Bitcoin always recovered. So only, in my opinion, that negates the point of this being a tulip bubble. Tulip bubble just, it goes to the roof, it explodes and never comes back. Bitcoin came back. And again, my advice would be, considering the facts that you have here about Bitcoin, and if you want to stay long only, if you cannot bear that kind of risk, just don't invest in it. It's that simple. The max drawdown is 90% of the whole time highs. If you want to limit your risk, just take a tiny part of Bitcoin if you still want to get into it. Nobody tells you to be 100% invested in this. But like the risk-adjusted momentum that I've showed before, I can show you that, by the way. Where is it? I'll try to go back on the risk-adjusted momentum. The risk-adjusted momentum for Bitcoin was actually very low. But why is that? So I told you that it might give you some indication about the positioning of CTAs in a market. And if you look at the allocation, what could be, an indication of an allocation of a CTA in Bitcoin. Again, this is not a target allocation. This is not an investment advice. This is just an indicator. Something that would go into CTA strategy would be more complex. So it's only an indicator, but you see that the risk-adjusted momentum is always very low. Why? Because the volatility of Bitcoin is much higher than any other asset in your portfolio. Obviously, much more than the US dollar, much more than the S&P 500. So if that would give you some kind of allocation here, the max allocation would be around 3, 4, 5%, considering the momentum, risk-adjusted momentum of Bitcoin, because when you compare to absolute momentum, it definitely beat any kind of other asset that we have here. But considering the risk, that just tells you that you have to have an allocation. When something in your portfolio is much riskier, you have to have an allocation that is much lower than any other thing allocation in your portfolio. So basically, this is where I wanted to go with these new kind of indicators that I wanted to show everyone to give you a better understanding of the market. Again, this was not any kind of investment advice. This is just for information, education, again, to better help you understand the market. So let me know in the comments if you'd like me to dig deeper inside that kind of analysis. This is what I do on a daily basis, not exactly this, because I simplify for you to have a better comparison. But this is the kind of thing I like to do, much better about discussing about what will be the expectation for the Fed going forward, although it has a major impact on the market, of course. But let me check the comments if there's anything coming. Fed should be grateful that equity momentum has paused. Yes, that's correct. But based on what I said before, honestly, I don't know. It will be interesting to see what the Fed will be doing, because again, it will be more likely that the interest rate expectations are going down. We'll see if this has an impact on the equity market. Usually there is a lag, that's why we have this negative correlation also between bonds and equities. Some of this that we had since the 1980s that just disappeared in 2022, 2023. But I mean, that will be, I think, like I said, like I've shown, things are currently seem to be changing in the market. It's very difficult to know where it's going. And so the next weeks will probably give us better clues on where the market is going, and I will comment this. And I think that was the right time to introduce the market dashboard in this weekly show, so that we can follow that closely. So thank you very much, guys. That was a good one. I don't have much questions. I have comments, but no question. If you see this, don't hesitate to put again some comments. I would really like to have some comments and feedback about the market dashboard, if this is something that we should extend or not, or shrink. If I should close down this show totally, just let me know. So thank you very much for your time. As always, enjoy your weekend. Have fun, spend your time with the family. The weather is getting much better here in South Carolina. We are in around the 70s this day with sun. So I went back to wearing my t-shirts. This is how good the weather is going back. But you're not here to hear me talk about the weather. So again, stay tuned. Next week should be interesting to see where the market is going, specifically on Monday, if the sell-off is resuming or the market is recovering. All the signs point that the market has no idea. It's very difficult to have some clues. The only sensible thing to do, I believe, at this point, would be either to hedge or to de-risk your portfolio, at least for a short period of time. Thank you, and talk to you soon. Bye-bye.